History teaches us one implacable truth, that no empire lasts forever, and what you'll discover in the next few minutes might just change your perception of the world forever. The Dutch, the British, and even the Romans all eventually fell, and now it seems we have another empire to add to this list. For nearly a century, the American empire has enjoyed total dominance on the world stage. Despite having only 4% of the world's population, they account for 20% of global income. This one country alone makes up almost 40% of the global military budget. But recently, this has been changing, and fast. By 2028, China is set to overtake the US as the world's largest economy. For decades, it's been positioning itself at the center of a new world order, waiting for its moment to pounce. Since 2010, they have invested well over $1 trillion in developing countries around the world. Meanwhile, the American world order has never seemed more fragile. Government debt has continued to pile up, and interest repayments now make up 1/6 of the annual budget. Decades of globalization are being unpicked right before our eyes. The trust America has spent generations building is slowly eroding through tariffs, erratic policies, and a growing sense that the rules no longer apply. It has been warned that power tends to corrupt, and absolute power corrupts absolutely. This isn't just about one leader, it's about what happens when an empire starts to believe in its own invincibility, long after the foundations have started to crack. The question isn't just about Trump, it's about whether America has crossed a point of no return. The infighting has already begun, but can the American world order survive, or are we already watching the opening act of a new global empire? Even a few decades ago, the idea that the American empire might start to crumble in the near future would have laughed you out of the room. By the 1990s, the country was celebrating the collapse of the Soviet Union. The dollar, already dominant, quickly became the undisputed currency of the world, and by 1995, it accounted for a staggering 71% of global foreign exchange reserves. The US had officially become the backbone of the global financial system. What's more, capitalism and democracy, the very foundation of American society, were quickly spreading across the globe. Even long-standing rivals, enemies of capitalism like Russia, Poland, and Vietnam, had begun to change their ways. The American empire had never seemed stronger, but while the country was basking in its post-Cold War glory, on the other side of the Pacific, a seemingly insignificant nation was quietly laying the groundwork for its own economic miracle. If you're watching this video, then you likely know the story. And by the way, if you enjoy this content and want to support this channel that grows every day thanks to your engagement, don't hesitate to subscribe and activate the notification bell. Every subscription gives us the strength to continue producing in-depth analyses that reveal the truths traditional media won't tell you. Your support makes all the difference in our mission to illuminate the crucial geopolitical issues of our time. By the 1990s, China had embarked on a journey that would totally transform its economy, reshaping the global order in the process. The Chinese economy would go on to grow by more than 9% per year, lifting millions out of poverty in the process. But far from being worried, Washington elites at the time saw this as a major win. Another communist power had changed its ways, realizing the virtues of market systems. When China joined the World Trade Organization in 2000, Bill Clinton didn't just see a trade deal, he saw a turning point in the country's future. By joining the WTO, China is not simply agreeing to import more of our products, it is agreeing to import one of democracy's most cherished values, economic freedom. The fact that China was still a one-party authoritarian state was brushed off as a temporary blip in an otherwise flawless capitalist success story. After all, as the country developed, they would inevitably adopt democracy, right? To American eyes, China looked like the proof that capitalism had won, and they welcomed the nation into the world order with open arms. From 1995 to 2010, Chinese exports to the US increased from around $100 billion to over $1.5 trillion. But while Washington believed it brought China into its system, they overlooked something deeper. Dripping water can penetrate stone. China wasn't being transformed, it was quietly, patiently transforming its position in the world. Economies typically undergo a transformation during development. In the early stages, they primarily produce agricultural goods, with most people living and working as subsistence farmers. Over time, populations shift toward urban areas and employment transitions to industrial and manufacturing jobs. This is exactly what happened in China from 1990 to 2020. Chinese manufacturing output grew from about $100 billion to almost $5 trillion, an increase of over 50 times. China had officially become the world's factory, and American consumers have been all too eager to accommodate. 97% of laptops and 78% of smartphones bought in the US are made in China, and China was producing more than just technology. 80% of all sporting goods in the US also come from China, and about 83% of toys. Far from being independent, America had secretly become completely dependent on China. To be clear, for the American consumer on a surface level, this is no bad thing. They have access to far more cheaper products than ever before at lower prices. And as cheap Chinese products flowed into the country, American consumers spent more and more, filling their homes with low-cost goods while quietly digging themselves into a financial hole. At the turn of the century, U.S. consumer debt stood at a steady $1.8 trillion. But by 2020, it had almost tripled to over 5 trillion. More Americans than ever were living paycheck to paycheck, relying on debt to finance their lives. And it wasn't just U.S. consumers that became reliant on cheap debt. By 2024, the U.S. government was also $36 trillion worth of debt. $1 in every $6 spent by the U.S. government is going toward repayment of this national debt. And it was showing no signs of slowing, and projections estimate that by 2034, the debt will have increased to $54 trillion. On a population level, this means that every American citizen would owe $150,000 in debt alone, thanks to massively overspending for decades. The country has found itself on the verge of a crisis. But this is more than just a fiscal issue, it's a textbook symptom of an empire in decline. Hundreds of empires rose and fell before today, but they all followed a similar path. Their collapse isn't a sudden event, but a gradual decade-long decline, and it always starts with an explosion in debt. Take the Dutch Empire in the 17th century. It was the world's leading financial power and seemed unstoppable. But gradually the government spent more and more, living beyond its means with little worry for the future. By the late 18th century, it had already begun to crumble. The signs were clear: a bloated government, rising inequality, and an over-reliance on foreign imports. Today, the U.S. finds itself in an almost identical position. Decades of overspending and dependence on cheap imports have left the country with fragile foundations that look set to collapse. But it's not just declining empires that tend to follow similar patterns throughout history. The rise of them have also followed a recognizable arc. It starts with a period of rapid economic growth, a manufacturing boom, rising exports, and an explosion in living standards. Then comes a growing international presence, expanding influence through trade, diplomacy, and strategic investment. As time goes on, the rising power begins to slowly replace the old order, reshaping global politics to place themselves right at the center. Today, China matches that description perfectly. For decades, the country has been setting itself up to define the new world order. Their strategy has been simple: invest now and dominate later. Unlike the US or Europe, China is not a consumption-driven economy. In America, 70% of GDP is spent on consumption, and in the UK this is 65%. In China, only 39%. Of course, if people aren't spending their money, then they are saving it. And these savings have generated a huge reserve of cash which the Chinese government and businesses can then funnel into long-term investments. High-speed rail, green energy farms, and semiconductor factories, all financed by the country's savings. By the end of 2023, household savings had reached a record $19.1 trillion, approximately $57,000 per person. This money isn't just being invested in China. By 2010, they had begun to look to the global stage with one goal in mind: building a new world order. At the heart of this strategy was the Belt and Road Initiative. Since 2013, the country has spent over $1.3 trillion funding ports, railways, and power plants in developing countries. The project now spans over 150 different countries, even landing in Europe and encompassing over 75% of the world's population. They've also heavily invested in supporting African development, a strategic move considering the fact that by 2050, the continent is estimated to account for over 25% of the world's population. In just the last decade, they financed 12,000 kilometers of road building and built more than 20 ports and 80 power facilities. The U.S. has had a far less impressive development record. Despite having USAID, the equivalent organization has built only 800 kilometers of road in the last 30 years, 15 times less than China. Instead, Rather than building infrastructure, U.S. international policy seems to have a different focus: fighting endless foreign wars. Since the turn of the century, the U.S. has participated in over 72 foreign conflicts. Take just one of these examples, the invasion of Iraq. It cost an estimated $2.2 trillion US. But after almost a decade of fighting later, there was nothing to show for it. For decades, the U.S. has been acting as the world police, trying to spread democracy and capitalism around the world, often by force. China, however, has a profoundly different approach. It isn't interested in reshaping foreign governments or imposing its political system. Instead, they operate with one objective: growing their own influence. And surprisingly, that doesn't mean more conflict, it often means the opposite. Rather than control, China seeks cooperation, building partnerships with all kinds of nations regardless of ideology, values, or governance. Where the U.S. tries to remake countries in its own image, China is happy to work with them as they are. And now we're witnessing a clash of these two opposing worldviews, and it looks like China is winning. In 2023, China's approval rating in Africa edged above that of the U.S. for the first time in history. And slowly, the U.S. international presence is crumbling, struggling to keep up with the efficiency of the Chinese machine. But here's the thing: the shift in power isn't just playing out overseas. For decades now, there has been a quiet economic phenomenon which has slowly been killing the U.S. economy: deindustrialization. At the start of the 1960s, manufacturing jobs made up about 30% of all employment in America. By 2020, this was down to just 8%. As global trade barriers began to fall, American companies were no longer confined to domestic production. Instead, they started looking abroad, chasing lower costs and higher profit margins. At first, the shift was slow. Textile mills across the American South quietly shut their doors as production moved to cheaper labor markets in Asia. Steel towns like Pittsburgh and Youngstown, once home to hundreds of factories, began quietly closing shop. But once the floodgates were open, there was no stopping it. What began as a trickle of closures soon became a mass exodus. America's industrial base, the very engine of its post-war prosperity, began to vanish. The sector that had once provided stable, well-paying employment to millions of Americans had been hollowed out, leaving the U.S. totally reliant on China. And the problems don't stop there. The manufacturing sector had once been the great equalizer, offering decent wages, job security, and a path toward upward mobility for ordinary Americans. Without it, many were left behind in a rapidly changing economy that rewarded capital, tech, and finance, not manual labor or traditional skills. Now you might be thinking, does all of this really matter? After all, since the 1980s, the U.S. economy has more than doubled in size, boasting the fastest growth rate in the developed world. Surely all of that economic growth more than makes up for the loss in industry. But here's the issue: economic growth figures don't take into account who the extra cash is actually going to. It's all well and good saying that the average person on paper is richer than they were 40 years ago, but this doesn't mean that most people's lives are actually getting any better. If all of the increase in income ends up going to the richest in society, most people's quality of life won't change at all, no matter what the statistics on economic growth say. And in America, that is exactly what's happened. Since the 1970s, the share of income received by those on middle and lower incomes has fallen, while those in the top bracket have continued to take up more and more of the country's wealth. Economic growth has made the richest few in America extremely wealthy. Today, the top 1% of the nation own over 30% of the country's wealth, up from 22% in the 2000s. But for those on lower incomes, it has meant very little. Since 2000, the average income in the bottom bracket has basically remained the same at $28,000 per year. All the while, the number of people in the bottom bracket has increased from a quarter of the population to almost 30%. While the nation celebrated booming economic figures, the reality for many has been starkly different. As the wealthiest occupy more and more of the income gains, the middle and lower classes have seen total stagnation. The American dream, the idea that anyone could achieve success through hard work and determination, now seems like a distant reality for many. To make matters worse, over the last 40 years there has been a complete explosion in house prices. In the 1980s, the average home price cost about $60,000. Today, those same homes would cost over $400,000, an increase of over 500% at a time when real incomes for the poorest have remained totally stagnant. Stagnant wages and rising prices have left the American public disillusioned with the establishment, and across the country there is the feeling that their institutions were failing them, and the demand for change grew louder and louder. In 2024, they reached a tipping point. Trump won a landslide victory on a promise to do exactly what the American people had been asking for: return America to its golden age. And his plan basically came down to one word: tariffs. The idea was simple. By putting a tax on imports, American companies would be forced to rethink their supply chains. To avoid the tax, businesses would be encouraged to relocate production back to the U.S., bringing the dying manufacturing sector back to life. And as a nice added bonus, they were set to raise $1.8 trillion over the course of a decade. Money the government desperately needed given the amount of debt they owed. In some senses, tariffs seemed like a clever idea, but as you know, they have not exactly been going to plan. Just 10 days after the announcement, the Trump team was forced to U-turn, getting rid of the majority of their tariffs. So, what went wrong? Well, the entire global economic order of the past 100 years has been built on their systems of free trade and globalization, with the United States standing right at the heart of this system. When the U.S., the very architect of global free trade, suddenly reversed course and imposed sweeping tariffs, investors were understandably spooked. And all of a sudden, one sector was threatening to jeopardize their entire plan: the bond market. If investors lost confidence and started selling treasury bonds en masse, interest rates would spike. And remember, the government owes $33 trillion. A 1% rise in interest rates costs them over $300 billion each year. A significant rise in interest rates would turn the government's unsustainable deficits into a full-blown fiscal crisis. But this wasn't just a failed policy. It was the kind of rash, short-term move that has historically marked the turning point of declining empires. From Rome to Britain, great powers often lash out with bold reactive decisions when their dominance begins to slip, clinging to control through tariffs, taxes, and isolation. America's sudden retreat from the very global system it built wasn't a strategy, it was a warning sign. So where does this leave the American world order? For decades they have reigned supreme on the global stage, and its dominance seemingly unshakable. But now cracks are forming, and mounting debt and rising inequality have begun to erode the foundations of American power. Meanwhile, across the Pacific, China has been playing the long game. While America borrowed to consume, China saved to invest, building the infrastructure and industries of the future. The contrast is stark: a nation burdened by debt and short-term thinking versus one focused on long-term growth and stability. As the U.S. grapples with its fiscal challenges, the world watches, wondering whether the era of American dominance is drawing to a close, and it seems increasingly likely that the Chinese century isn't just possible but inevitable.